Why do I need a quality of earnings report if the seller already has audited financials? That's the question we're going to answer in today's video. My name is Zachary Jensen. I'm the managing partner here at TaxWise Financial Services, where we're empowering small business owners with tax savings so they can build more wealth. Today, I want to go over the importance of getting a quality of earnings despite having audited financials and what the actual differences are between a quality of earnings and a audit itself. So in the realm of mergers and acquisitions, obtaining a quality of earnings report is a critical step in the due diligence process, even when the financials of the seller have already been audited. While audits and QOE and analysis both share different insights in a company's financials, they serve a distinct purpose and offer a different perspective. So understanding the difference here is critical for buyers, just so they understand, okay, what am I actually getting into when I'm looking at an audited financials versus a quality of earnings report financials. So let's break it down here. Number one is going to be the purpose and focus. So the primary purpose of an audit is to provide reasonable assurance that a company's statements are free from material misstatement and conform to relevant accounting standards such as IFRS or US GAAP. Auditors assess whether the financial records accurately reflect the company's financial position at a specific point in time. However, audits do not delve into the sustainability or quality of the earnings reported. In contrast, a quality of earnings analysis aims to evaluate the sustainability and accuracy of a company's earnings by adjusting metrics like EBITDA, which is earnings before taxes, interest, and depreciation, to reflect true financial performance. This involves identifying non-reoccurring, non-operational, or one-time purchases that may distort the company's actual earning potential. For instance, if a significant portion of EBITDA stems from a one-time gain, a quality of earnings report will highlight this, enabling the buyers to assess the true value of the company. This forward-looking approach is critical for buyers to avoid overvaluation and potential post-acquisition financial surprises. Number two difference is the scope and timing. Audits typically cover the most recent fiscal years, providing a historical snapshot of the company's financial health. The audit process involves testing internal controls, conforming account balances with third parties, and conducting an analytical procedure to detect irregularities. This rigorous process ensures compliance with accounting standards, but does not extend beyond the audited periods. A quality of earnings analysis, however, encompasses a broader scope, and it not only reviews historical financial data, but also examines interim periods up to the point of analysis. For example, if a quality of earnings report is commissioned mid-year, it will assess financial activities from the end of the last audited fiscal year through the current interim period. This comprehensive approach provides buyers with an up-to-date insight into a company's financial trajectory, including recent developments that could impact future performance. The third is the actual procedure and in-depth analysis. The procedures undertaken in the audit and quality of earnings analysis differ significantly. Auditors focus on verifying the accuracy of financial statements through methods such as physical inventory counts, confirming with customers and suppliers, and assessment of internal control systems. While this is very thorough, this process is primarily compliance-driven and may take several months to complete for much larger companies. While thorough, this process is just primarily compliance-driven and less focused on figuring out the actual earnings of the business. So in contrast, the QOE analysis is much more investigative and analytical. This is conducted over a shorter time frame, often weeks, and it involves a deep dive into the company's financial performance to assess factors like revenue retention practices, expense management, customer retention, and the impact of non-reoccurring transactions. The goal is to adjust reported earnings to reflect a normalized and sustainable financial performance, providing a clearer picture of the company's true earning capacity. This analysis is particularly valuable in identifying any aggressive accounting practices or financial anomalies that could affect the valuation and future profitability of the business. So while these both are different, they both offer a complementary role in the holistic due diligence process. So while both audit and QOE analysis scrutinize a company's financial information, they are not interchangeable and rather complementary. An audit ensures the financial statements adhere to the established accounting standards, offering a baseline level of assurance regarding to their accuracy. However, it does not assess the quality of sustainability of the earnings being reported itself. A QOE analysis builds upon the audited financials by providing a nuanced robust evaluation of the earnings quality, adjusting for any anomalies, and offering insights into the future financial performance. And for buyers, this means gaining a comprehensive understanding of what they are acquiring beyond what is presented in the standard financial statements, which is so critical. Most deals do not work out, not because of the numbers, but because of things that are missed in due diligence. This dual approach helps in making informed decisions, negotiating fair practices and for purchase price, and identifying potential risks that could impact the success of the acquisition itself. And I just wanted to share an anecdote from the real world just to highlight the importance of a QOE analysis. So for instance, Macy's encountered a significant error amounting to over $130 million due to deliberate misstatements of an employee, raising questions about the effectiveness of their internal controls and reliability of their audited financials. Similarly, a company called Evolve, a security technology company, faced issues where they were premature or incorrect in recognizing revenue, and this led to unreliable financial statements over multiple quarters. And in these cases, the audits were actually being done properly, but they weren't able to detect the underlying issues affecting the quality of the earnings itself, and that's where a QOE can come in and address such discrepancies. So in the end, due diligence is incredibly important with a audit and a QOE alike. You definitely want to get a QOE no matter what size deal you're doing. It offers an analysis that's much more deeper, focusing on an examination, adjusting for non-recurring items, and providing insight into future performance. However, the numbers just tell one half of the story. If you are going to get a quality of earnings, go with a business that is actually bought businesses before. There are a lot of accounting companies that do quality of earnings, but you want to work with someone who has bought businesses and has helped other people buy businesses, because they're going to go into a much deeper depth as far as due diligence goes. So obviously I'm biased because that's us. If you have any questions about how the quality of earnings that we offer differs from our competition, feel free to reach out in the description below. Thanks so much for watching and have a great day.